Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be talking about M1 Finance's portfolio and how you guys can create your very own, essentially an ETF, an exchange traded fund, without the expense ratios. So in today's video, we're going to talk about one fund that I had talked about previously, which was the Essential 40. Now, I've already brought up a little article here. Let's go ahead and bring that up. So the Essential 40 is basically 40 stocks that are essential to life right now. This is a mix of active and passively managed stocks. Each stock has a weighting, 2.5% weighting, meaning that it's pretty diversified. No one stock is greater than another, and it has a very unique range. So it has many tech stocks, techs and services. It has energy, has healthcare, financials, materials, industrials. You have some staples, and you have some discretionary, and then just the one telecom stock, which is Verizon. I would have chosen AT&T over Verizon, but to each their own. Also, this one holds GE, which right now we're just basically going to be going through, and I'm going to show you how you guys can make your own exchange traded fund. If I am talking a little bit quiet, it's what, 12:50 in the morning right now. I have to be up and do some work at 1, so that's why I'm up right now. So I'm going to try and make this video quick. We're going to be creating our portfolio over on M1 Finance that'll track basically the Essential 40 without the expense ratio, making sure that all those earnings and capital appreciation dividends that you make for your future are 100% yours. You don't have to pay a financial advisor to manage your portfolio, and there's not going to be any expenses coming out of your portfolio because you're using M1 Finance, which is fee free, and it offers free investing, free stock buys, so you can buy stocks for free. So what we're going to be doing is selecting add slices, and we're going to be starting here by beginning to add some of these stocks in. So all we have to do is select the stock, type them in, hit the plus sign, and it's going to queue them up towards the bottom. Now we're going to go through here and add all of our tech stocks in, which we have Facebook, we have Amazon, we have Cisco and the infrastructure, we have Google with the services and tech, Apple with their tech and services. We have some big names here. Apple, more tech, more services. We have Intel. These are all very good large companies. ADP, known for their human resources. If you log into iPay, maybe not iPay, I believe that was in the military, but if you log into, to view your paychecks and such, a lot of times you'll be using either ADP or Paychecks, I believe. So that is ADP here. That was our last one in the tech sector. So we're going to hit and hit add, and that will have added our stocks into our portfolio. So we have 2, 4, 6, 8 stocks now. 2, 4, 6, 8. Okay, that's correct. Let's go ahead and get into our energy. So next we're going to be adding Exxon, Duke Energy, EPD, and those are our 3 energy ones. So I'm going to go ahead and add. Next we go into our healthcare. So we have our United Healthcare, our Bristol Myers. We have to hit the plus. If you don't hit the plus, it won't queue it up at the bottom, and you'll end up missing it. And then with a list like this, it'll be really hard to find out which stock we did not add in. And then Johnson & Johnson there, so that's a pretty good, well diversified healthcare area. So now we're going into our financials. Visa, accepted everywhere. I would always choose Visa over MasterCard. JP Morgan, one of the largest banks and financial institutions. I'm surprised they don't have Goldman Sachs on here, but JP Morgan's a great bank too. And we have CME Group, we have AIG, and what appears to be Berkshire Hathaway. This has a B at the end. The ticker symbol that they use is the A, which is the incorrect one. So I'm going to go ahead and add B. and that is our financials. So we've added our tech, energy, healthcare, and financials. Now we're going into our materials. So IP is the paper company. Great company. I've owned them in the past. Dow DuPont. Great company. Monsanto. X. I've never heard of X. That's US Steel. And then Potash. I don't believe we can add Canadian stocks in here, but we can definitely try. Let's go ahead and hit Potash. That's Intrepid Potash Inc. I don't believe that's the correct one, so I'm going to go ahead and leave this one out. And what would be a good material stock? I can't think of one off the top of my head, so I'm going to go ahead and just continue on to the industrial. So we're going to add these in, continue into our industrial sector. Waste management, good company. We have Triple M. So a lot of these names you may recognize. American Airlines. These are just, the essential 40. American Airlines, when you're flying anywhere, you may fly Delta, American Airlines, but these are some of the big names that are, going to be used. FedEx. You could also throw UPS in there instead. It's really up to you how you want to diversify your portfolio. General Electric, you may not want to hold General Electric, but it could be bottomed out. You can see here it did bottom out. I'm sure during this this correction period, it's just a good time to buy these stocks because they basically bottomed out. So last one on our industrials was Lockheed Martin. We added those in. Next we go to our staples. We have Costco, great company. We have Cisco for their delivery of food. I remember I've seen Cisco trucks everywhere just delivering foods. And then CVS. Those are pretty good companies right there. So those are some staples. Next we go into our discretionary. We have CVS. We have Comcast. Charter. I don't usually see a lot of Charter. I know a few people that work at Charter, but very little that invest in Charter. We have Home Depot. That's another one. I'd probably choose Lowe's over Home Depot. And then we'll add those in. And then last, we have Verizon. So let's go ahead and add Verizon in here and add it to our portfolio. So that should give us 29 stocks. Let's go ahead and hit Save Changes, confirm. Now we have our portfolio in there. So we can see over the year, this Essential 40 increased by 12.77% over the last year. Now some of the stocks that may have affected this portfolio negatively would be General Electric or General Motors. If we remove it from our portfolio and hit Save, it'll probably adjust this, but I'm not going to go ahead and do that. I'm going to go ahead and just hit refresh, and that'll bring it back in because I've already saved it with General Electric in there. So all I did is bring it back in. So I am missing one stock. You can see here that if I had Toronto Stock Exchange, this would all be weighted at 2.5, but because I do not have it in there, I currently have 39 stocks, I believe. So if we go through here, we'll have 1, 2, 3, 4, 7, 10, 20, 30, 8. So we have 38 stocks in there. So there may be one that I missed. So if you guys saw which one I missed, but I know we missed this one here, the Potash one, because I could not find the ticker. One other one I'm just going to add in for telecom is going to be ticker symbol T. I'm going to go ahead and add that one in there. And discretionaries, where are we missing? Some staples. I'm going to go ahead and add I'll go ahead and leave that as it is for now. So I'm going to go ahead and equalize targets. So everything is at 3% and 2% right here. So it looks like it doesn't go into the 0.5s. So you can't enter at 2.5. So that's why some of these are showing up as 3% target, and some of these are showing up as 2% target. So I'm going to go ahead and hit save changes. So now we currently have 39 different stocks in here. You can see here that the performance in this stayed about the same even with the addition of AT&T. So we have 11.79% return over the past year. We have an average yield of 2.18, meaning that for every $100 that we have invested in this portfolio, we will get roughly $2.18 back from dividends for the entire year. So if you have $1,000, you'll get roughly $21.80. If you have $10,000, you'll get $218 back in just dividends. Oh, it says right here we have 39 holdings, so we are missing one stock. And you guys can add whichever kind of stock. So here we essentially made our essential 40. So essential 40, well, it's actually 39, so no copyright, we got our essential 39 stocks. Now you can mix and match. If you would like to remove General Electric and add some other industrial company, I would recommend that. I'm sure without General Electric being in there, it does actually have a lot more up potential than down potential as they begin to split up, but who knows if their price will drop once they begin to split up. And I'm sure even if it does, you'll get other companies, as they split into more companies, you'll be rewarded with the companies that they split into. So that is basically it. We have created our essential 39 portfolio. It has an expense ratio of 0. We are holding 39 stocks. We have an average dividend yield of 2.18. And if we go to our portfolio now, it does show up here. If we added funds into this portfolio on the next trade day, our M1 Finance app would buy, basically whatever the actual, it would buy into the target to match the target. So we would put in our money in there, and then whenever it hit the target cap, whenever the actual percentage would hit the target cap, it would stop in that specific stock and continue on until all of them were funded. And then if you would want in the future, there'd be a rebalance here, so you could rebalance your portfolio if it begins to get overweighted in one specific sector and you feel that you can rebalance it, and some of your lower hanging fruit will be able to grow, gain some capital gains, and that'll bring your portfolio back up better. So that is basically it. We have covered how to create your own exchange traded fund. If there's an exchange traded fund out there, I'm not sure how many stocks you can actually have within your portfolio, but you can see here that we have 39 different stocks on our M1 Finance. So when money comes into this portfolio, it'll get split up between 39 of these stocks. Now this may be a little bit more diversified than what you want. Everyone is different. Diversification, there is not a wrong way or a right way to do it. The more diversified you are, the less risk you may have, but at the same time you don't get as many returns. Whereas the less diversified you are, if you're only buying one or two stocks and those stocks go up 10, 20, 30%, then you get the higher risk and reward, because those same stocks could go down by 10, 20, 30%. So diversification, it's all up to the person and what their risk level is. So that is it for this video. I hope you guys have enjoyed the video. If you did, remember to like this comment or like the video. Remember to leave a subscribe for future financial videos. Thank you guys for watching up to this point. If you are brand new to my channel, do hit the subscribe button. I really appreciate it. And that is it for this video. I thank you guys for watching. I will see you next time. Have a great day. Bye.